Welcome to the Daily Brief, where I'll go over the highlights of the action in the market for Tuesday, November 1st, and then we'll see how things look for Wednesday, November 2nd. And this will be the only video posted again today. Both Monday's action and Tuesday's action was kind of slow and not necessarily a surprise because we're getting ready for the big announcement coming out Wednesday with the FOMC. What they're going to do is not necessarily a surprise. It's looking like they're going to do 0.75% rate increase or 75 basis points. What's going to be interesting is what is said, not only when they make the announcement, but then at the press conference that follows. And the market's going to be very carefully dissecting everything that Chairperson Powell says to try to get some hints that maybe they're going to lessen the rates in December, not by decreasing the interest rates, but instead of doing a 75 basis point move, which has kind of been the plan so far, maybe just doing a 50 basis point move. And so that's what we're really going to focus on in the session. So let's go back and talk about what did happen. It was a pretty slow day. That's why I'm only doing a daily brief video. At the open, we did gap higher. The futures were stronger. Things were looking like, okay, maybe we're going to get some thrust to the upside. And we did right off the bat. We opened all the way up to R2. Now, the pivot levels were kind of close to each other because Monday's session didn't have a real wide range. And the daily pivots are calculated based on the previous day and the range of that day. But we got up to R2 at 39.07, so we got above the 3,900 mark. And at that point, we were up about 1%. Prices then quickly fell below R1 and went down to 38.89, fell below the daily pivot at 38.76, and then went negative. As the day went on, prices then fell below S1, down to 38.59. They bottomed at S2 at about 38.46 before spending the rest of the day just going above and below S1. And that's right about where we closed, just slightly below S1. We were down 0.41% by the end of the day. Volume was just average. We were a little bit below the moving average, and so things are quieting down right now as everybody gears up for what's going to happen on Wednesday. The technicals are remaining positive. They're still holding up overall, and we could launch from here if the market really likes what it hears. If they don't like what they hear, then there might be some issues, but this is short-term in nature. Usually what happens is when we get some kind of a short-term event, after that gets finished, we go back to the trend that was in place before then. Now, it's a little bit hard to decide that because in a bigger picture sense, we're still in a downtrend. But on a short-term basis, things are improving, and it's looking like we could build a base to get set to go higher. So that's what's making it kind of confusing right now. You could go either way with what's it going to revert back to, or is it going to continue after some kind of an announcement is made? And this is all being caused by inflation and interest rates. And the market has been improving as they feel like they understand a little better what's happening. The Wall Street Journal article that came out over a week ago said that the Fed is going to go ahead and raise interest rates 0.75% at the meeting that will be on Wednesday, and then possibly in December, still raise rates, but a lower amount, maybe 50 basis points instead of the 75 basis points. The market's like that. It's been able to get some support off of that now, and that's coming from an article. What the market is waiting for now is we need Chairperson Powell to confirm that or give some signs that something like that is going to happen. Of course, we have all the geopolitical concerns, Russia, Ukraine, the whole situation there. We've got a whole slug of earnings reports that'll be coming out in Wednesday's session. the Fed speak, which is in blue. They can't say anything before this announcement is made on Wednesday, but they'll be sure saying a lot after that. And the person who really counts the most is Chairperson Powell, because he's the leader of the Fed. And then, of course, the whole midterm election that's coming up next week. That, again, may not really have a direct impact on the market, but it may have an impact on future policy and different laws and regulations, either that they increase or take away. And that may have some longer term ramifications. So what are some comments that we can make? Stock price movement and volume is slowing. That's why we dropped down in volume in Tuesday's session ahead of the FOMC announcement. The technicals are still positive and they're still holding up. This is after Friday's big run up, we were overbought. Now we still continue to be overbought, but the declines that we've seen both Monday and Tuesday haven't had a lot of intensity. So that's more healthy, and it's letting some of our longer term indicators show more improvement. It's weakening some of our short-term overbought conditions, not all of them. We still have a lot of short-term indicators that are still overbought, but as I keep saying, just because we become overbought or oversold doesn't mean we have to stop right there. We can continue to move one way or the other. Also, China may be loosening its zero COVID policy. This was taken as a positive, mainly from an American standpoint, that might help some supply chain issues because they're still locking down and having restrictions in certain areas in China, and that's affecting the whole supply chain. The markets then reversed after the jolt job openings came out. No, this is the chicken and the egg kind of thing. Did the report shock the market, or did the market hit resistance and start to fall back? I have an intraday chart where I'll show you. I kind of go with the latter. I think we went up as far as we were going to go, and we went down, and there was a lot of selling that eventually took us negative, but it wasn't the news causing the move. It was more of a move that happened with the news coming out at about the same time. But that's kind of a debatable topic back and forth. We did hit some resistance and then fell back. Small caps and mid caps did outperform, and this could give some support to stocks. They did better than the S&P 500. The VIX is still oversold. As we've been going up, the VIX has been coming down. Our RSI chart is still extreme negative, which could be a negative for the market. The S&P is still above its 50-day moving averages, both the exponential and simple, and we're right below the 100-day simple moving average, which now, after it recalculated, yesterday it was at 3,900, now it's at 3,899, so roughly 3,900. And that is acting as resistance, and other support that we have below current prices, that is still holding. So these are positive things. Interest rates were mixed. They were kind of all over the place. And the Dow is right at its 200-day simple moving average. That's a big one. If the Dow can get some support and go back up and stay above its 200-day moving average, that is considered positive. If it drops down below that, that will be a return to looking more negative. And then this whole scenario that I've been talking about, that they're going to go with 75 basis points at Wednesday's session or Wednesday's meeting, and then in December possibly not increase rates as much, that still continues, and that has been valid, and that has given the market some answers to have a little bit more confidence of what's going on. We still have a lot of our yield curves that remain inverted, the 10 to the 5, the 10 to the 2, the 10 to the 3 month, the 30 to the 5, those are still inverted, and they typically can signal, especially when we see a whole lot of them at the same time, that in the future we're probably going to go into a recession. There's a case to be made that we might be in a recession now. That's debated back and forth, but regardless of what your definition of a recession is, with all these yield curves inverted, that typically means that we're going to see economic weakness into the future. Sentiment is still positive. It ticked down a little bit in the greed area because of the decline, but at the same time that it's not extreme and it's still leaning more towards the positive side of things. We had the ISM manufacturing index. That was the big report that came out. It came out at 50.2. They expected it to come in at 50. And 50 is the line in the sand. If we're above 50, that's showing growth. If we're below 50, that's showing a contraction in the economy. The last time we got this, it was at 50.9. So it came in lower than last time, but a little bit higher than expected. And then construction spending, it was up 0.2% on a month-over-month basis. That's a lot higher than what they expected. They expected it to be down 0.5%, and that translates into a year-over-year increase of 10.9%. And this is the JOLTS job openings, which is kind of being blamed on the fall that we saw during Tuesday's session. But they totaled 10.717 million jobs that are available. Last time it was 10.280. So what is that? 500,000 job increase, which this is giving more credence to the Fed being stronger with their interest rate increases, and the market doesn't really like that. We're going to get the whole employment situation report on Friday, and that's the one that the market kind of officially looks at to get its clue as to what's happening in the job market. Our trend, it's still positive, but it's weakening. We're into the 20s now, but 20 and some change. We haven't dropped below 20 yet. I'm keeping our bias at mixed, just because Monday and Tuesday, there wasn't a lot of conviction behind the price movement, and we're kind of coming off of more of a positive backdrop. Now, you could say that it's negative because we had 2 negative down days in a row, but right now I'm just kind of personally seeing it more as mixed, and I'm keeping our momentum as positive, kind of for the same reasons that the market's just in wait and see mode right now to see what the Fed does and what they say before it reacts one way or the other. All right, and then currently, this is our tongue-in-cheek. People like to find connections between things, but this is just coincidental. As of the latest in the World Series, Philadelphia is up 2-1 over Houston. So we'll just have to see how that literally plays out. Okay, here's an intraday chart. I didn't include any charts in yesterday's video, but I'm going to go ahead and do that today, where we did spike all the way up to R2, and that we pretty much set in the high, just a little bit above R2. And then shortly after that was when there was some economic data that was released. We saw a real fall below the daily pivot. The dashed line is the unchanged level. We went below that, fell below S1, came all the way down to S2. That acted as support, and then we just kind of bounced around S1 for the rest of the session and closed near S1. Here's a daily chart showing that we're still above the 50-period moving average, and we haven't really broken any support on this chart. And other charts that I'm not going to show you, the fib levels, both shorter term and longer term, those levels are still holding up currently. And then down at the bottom, you can see where we were just about average with the volume. So what's our outlook then for Wednesday? The technicals are still leaning positive. We have some of our short-term overbought signals that are being worked off, not all of them. The McClellan oscillator is still extreme positive. Some of our PMO studies are still extreme positive, but some of the other indicators, at least they're coming down a little bit, which theoretically could give the market more room to the upside if it starts going up. We have the weekly MBA mortgage index that comes out and the ADP employment change. And then the big one is going to be the FOMC decision at 2 p.m. Eastern. The news conference will be at 11:30. 11:30, my goodness. That's West Coast time. It'll be at 2:30 p.m. Eastern time. And this may produce a real gyrated reaction. Quite often what I do is I'll have a 1-minute candlestick chart that I'll show in tomorrow's video just to show how the markets reacted and then reacted to the reaction and gyrated all over the place if we see a lot of that in Wednesday's session. We have the whole list of geopolitical events. again, unless something else happens, it's the Fed right now. That's what the markets are fixated on. All right, so our scenarios, we do have all of these different headwinds, which at some point could become tailwinds if things turn more positive, like the whole China situation with them potentially loosening the COVID restrictions there. That was taken as positive. But our technicals are more positive, so we can't really go with the down scenario with some of our short-term overbought signals being worked off. We're going more with the positive scenario right now, even though there are some short-term overbought signals. Our scenarios, the sector rotation, that's just not happening right now, especially when you look at the NASDAQ and the NASDAQ 100 and compare it to the S&P. We're seeing a lot of our growth ratios decline. We're seeing the Qs to the S&P really decline. So we'll just have to see if that can get better at some point, but it's just not really helping us. Where our other setups that we're looking at, both with the 50-period moving average setup, the 200-day moving average setup, our highs and lows, our VIX, our equity put call ratio, not so much our VIX because that's oversold right now, but those things are still holding up and could be used as positive setups. Technicals still hanging in there positive. We're right in that area with the moving averages, the pivot levels. We're still staying above most of them with the S&P as far as the fib retracements and using different support and resistance levels. The ADX is weakening. Now, if we get another kind of do nothing day, if nothing is really decided on Wednesday, the ADX, which has been declining, it may be getting close to dropping below 20, which would put us more into a trendless environment. So we'll have to see how that works out. But for right now, it's still above 20. The green line's on top, even though it's been declining. So it is positive. So our conclusion then is the S&P remains positive, but we still have some short-term overbought signals that are generating those signals, but some are being worked off. Short-term, we're seeing a lessening of some of our overbought signals. Intermediate term, we still have a few, like the CCI charts that I show. Those are still extreme positive. And then long-term, we're still showing some improvement with our longer-term charts, but unless we can get back to that 200-day simple moving average, we remain negative. So thank you. Have a wonderful Wednesday. I will probably prepare a full-length video for Thursday's session just because there's going to be a lot of announcements, especially if we see a lot of price movement and a real pickup in volume.